The year ended August 2025 was an encouraging one for Asian markets. The Henderson Far East NAV total return was up 12.7%. And to put that into context, that was just behind the MSCI All-Country Asia-Pacific ex-Japan High Dividend Yield Index, which rose 13.9%. So we're pleased with how the strategy is positioned given the markets have moved quite strongly, and there are many structural opportunities still in those markets. Markets in North Asia were strong contributors to performance this year, particularly China, Korea, Hong Kong, and Taiwan. And technology stocks within that were really the standout performers in the year. And our portfolio was a beneficiary of this, given the strategic shift we had made. We had moved from purely high-income value stocks, which would not have performed in this environment, to a more balanced approach that included both income and growth. The surge in AI-related investment globally has powered Asia's technology supply chains, making the sector the strongest contributor to returns. But actually, it wasn't just tech. Themes like corporate reform in Korea, lower interest rates in Hong Kong, and also a growing infrastructure and financial inclusion across the region also supported performance. Our performance was driven by a unique mix of high-income and high-growth technology names. On the income side, companies like China Hongqiao, the largest global aluminium manufacturer, and China financial holdings such as China CITIC Bank, China Construction Bank, and New China Life performed very well, as investors are looking for more income, especially in China in a lower rate environment. Alongside that, high-growth names such as Sea Limited, Quanta Computer, and TSMC benefited from this global technology momentum. However, not every market contributed positively. India and the ASEAN region, particularly Indonesia, Malaysia, the Philippines, and Thailand, were lagging behind. And even though our exposure was limited, energy and IT holdings such as Bharat Petroleum, Woodside Energy, Infosys, Power Grid, and Gale did weigh in our returns over the year. During the year, we made some portfolio adjustments to strengthen our positioning. The change in country allocation was really the most notable shift. We reduced exposure to Australia and India and used those proceeds to increase our holdings in China. Though I have to say, we are still broadly neutral versus Asian indices, and there are still some concerns about the macroeconomic data in China, which hasn't really improved. We added a number of names such as New China Life, Kerry Properties, and China Hongqiao Group to the portfolio. Companies we believe that offer both growth, resilience, and dividend potential. And in contrast, we exited a number of Australian mining names such as Pilbara Minerals, Rio Tinto, Fortescue, and BHP Group, and also Indian IT firms, Infosys and HCL Technologies. And alongside that, we also exited the Indian energy company NTPC and oil and gas company Bharat Petroleum. These funds are reallocated into China tech giants, Tencent and Alibaba, and also North Asian technology firms, including Quanta, SK Hynix, and SK Square, which are all positioned very well for the next phase of growth in technology. Looking ahead, we remain confident in Asia's long-term potential. The region is supported by powerful structural growth themes, such as technology supply chains, which are driving global AI investment, to expanding financial systems in Indonesia, the Philippines, and India, and also large-scale infrastructure spending across our region. Furthermore, the rise of strong domestic brands in China, which are making very successful inroads into foreign markets, and the ongoing corporate reforms across key Asian markets such as South Korea, China, and even Indonesia, are unlocking new sources of value for us. With attractive valuations and some of the lowest dividend payout ratios globally, indicating rising dividend potential, Asia continues to offer a compelling environment for investors seeking both income and growth. Our confidence in Asia's future, particularly China, is reinforced by effective leadership responses to global shifts, and these are maintaining stability and leaving ample policy tools available to support continued economic growth in our region.